and gentlemen, good day and welcome to Ugro Capital Q2FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Shweta Daptardar from Elara Capital. Thank you and over to you, ma'am.
Thank you, Arshi. Good evening, everyone. On behalf of Elara Securities, we welcome you all to Q2FY26 earnings conference call of Ugro Capital Limited. From the esteemed management, we have with us today Mr. Shachindra Nath, Founder and Managing Director, Mr. Anuj Pandey, Chief Executive Officer, Ms. Shilpa Bhatter, Chief Financial Officer, Mr. Sameer Nanda, Chief Revenue Officer, Ms. Ritu Singh, Senior Economist and Head Investor Relations. We express our gratitude towards the management of Ugro to provide us the opportunity to host this conference call. Without further ado, I now hand over the call to Mr. Shachindra Nath, Founder and Managing Director, for his opening remarks, post which we can open the floor for Q&A. Thank you and over to you, sir.
Thank you. Good evening, everyone. Welcome to Ugro Capital's earnings call for the second quarter and half year ended 30th September 2025. Quarter 2 FY26 was a period of strategic recalibration for Ugro Capital. Over past 3 years, we have consistently added around 3,000 crore of our AUM annually, reflecting the strength of our franchise and the scalability of our data tech-driven model. With the proposed acquisition of Profectus Capital, which will add approximately 3,000 crore inorganically and take our total AUM over 15,200 crore, we consciously moderated disbursal this quarter to optimize our liability requirement and borrowing costs. This prudent approach, supported by tightened underwriting, aligns with the prevailing macro headwinds in the small ticket MSME segment. As of September 30th, 2025, our asset under management stood at 12,226 crore, up 20% year on year. Our calibrated disbursal on account of tightened underwriting are recorded at 1,789 crores in Q2 and 3,380 crores in first half. Following signs of over leverage, we have curtailed throughput rates from 30% to 20% and tightened underwriting filters. These risk management measures, combined with a strong on-ground collection and 4-tier recovery structure, ensures portfolio resilience and consistent profitability. Our total income grew 35% year on year to 461 crores and PAT rose to 43 crores, up 22% year on year and 27% quarter on quarter. Asset quality remained stable with GNPA at 2.4% and NNPA at 1.5%, backed by a 47% provision coverage ratio. Our CRAR stood at 25.4%, reflecting a strong capital adequacy and ample growth headroom. In October 2025, we raised 535 crores of equity, earmarked for Profectus acquisition. On account of Profectus acquisition and fundraise, India Rating updated its long-term rating to A+, rating watch with positive implication. Our emerging market vertical, which is micro lab business for small business enterprises, continue to perform well. We added 90 branches in first half of FY26 and now 303 branches across 13 states, with asset under management reaching to 2,997 crores, contributing now to 25% of our total asset under management. The expansion phase is now complete, and our focus has shifted to branch-level productivity and profitability. 29 of our emerging market branches are already operating above 1 crore of monthly disbursement. 86 are expected to reach that level within next 12 months, and the balance 188 in next 18 months. As a steady state, the business is expected to deliver 18% yield 4% of GNPA and 1.5% of credit cost, contributing to at 40 to 50 basis points return on asset improvement over the next 6 quarters. Our embedded financing through the acquisition of MyShub Life platform continues to gain strong traction. The asset under management has reached to now 1,270 crores within 4 quarters, serving more than 1.5 lakh small retailers. Disbursement stood at 713 crores in Q2, maintaining a steady monthly run rate of approximately 200 crores per month. This business addresses a $20 billion of credit gap in the small retail and micro merchant space and represent one of the most scalable parts of our portfolio. The ongoing acquisition of MSL will enable deeper integration of Ugro's digital credit ecosystem, strengthening our embedded finance play. The portfolio quality continues to remain stable with gross NPA at 2.4% and net NPA at 1.45% as of September 2025. Our total collection efficiency improved to 100% this quarter from 96% last year, with 93% of our assets are in stage 1. We have tightened underwriting standards in the unsecured segment, bringing down throughput rates from 30% to 20% and maintaining conservative provisioning. Our 4-tier collection framework and data-driven early warning systems continue to ensure resilience and stable profitability. On the liability side, we continue to diversify our funding mix and strengthen our off-book strategy. Currently, around 43% of our asset under management is off-book, which is roughly half of it comes through co-lending originations and another half through direct assignment. We expect that the Profectus acquisition, which is entirely an on-balance sheet business, our combined off-book AUM will moderate to around 35%. With the rollout of new co-lending guidelines and the uncertainties around their interpretation and implementation, we are moving gradually on volumes to fully understand the framework and prepare our systems accordingly. Over time, we would like to maintain the co-lending and off-balance sheet in the range of 25 to 30%, but there are strong demand and momentum in co-lending, so we will remain flexible depending upon market conditions. There is no hard ceiling. Our approach will continue to be pragmatic and opportunity-driven while ensuring balance sheet stability. It is also important to highlight that we are currently holding cash on our balance sheet for the Profectus acquisition, entirely funded through internal accruals. This reflects inherent strength of our operating cash flow and disciplined capital management. The cost of borrowing has improved to 10.37, down 38 bips year-on-year, underscoring the benefit of diversified and high-quality lender base. To summarize, this quarter reflects Ugro's evolution from an expansion-led to a productivity-led and profitability-driven phase. With our emerging market network now fully built out and the MSL platform scaling rapidly and the Profectus acquisition on track, Ugro is entering a period of structural profitability improvement. Our portfolio quality is strong, our balance sheet is well capitalized, and our technology-led distribution model continues to deepen across ecosystem. We remain confident in our mission of solving the unsolved, bridging the MSME credit gap in India through the power of data, technology, and prudent risk management. Thank you all for your continued trust and support. My team and I are happy to answer any of your questions. Thank you.
Thank you, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. I repeat, if participants need to ask a question, you may press star and 1 on your touchtone telephone. The first question is from the line of Mr. Shivam Singh, an individual investor. Please go ahead, sir.
Am I audible?
Sir, you are not audible. Can you speak a little bit louder?
Am I audible now?
No, sir.
Just a second. Audible now?
Yes,
you are.
So congratulations on the great results. Sir, there was a green shoe option of 100 crores in a bond raise that we did right now. That was at 11.65%. So since we are working on bringing our cost of capital down, so why would we raise capital at such a high interest rate, and that too for 5.5 years?
Thank you so much for your question. So we have just now raised subordinated debt from the debt capital market, and therefore you see that the coupon there is 11.65, and essentially as per the RBI guidelines, an instrument to qualify as subordinated debt needs to be 5 years plus in maturity, and therefore we've done that. And given the fact that subordinated debt forms as tier 2 capital for the company, we were very happy to raise this debt, and we have seen an overwhelming response as well for our raise that we have done of subordinated debt.
So just to add what Shilpa said, sir, you should compare this as a cost of equity and not cost of debt. A subordinate debt which actually forms up our capital structure and actually enhances return on equity. That's why normally perpetual bonds, tier 2 capital, subordinated debt would have certain bits higher than the normal debt.
Okay, thank you, sir. And sir, there was something else that I wanted to ask you. Sir, we are adding branches and we are raising capital, but our disbursement number isn't growing in proportion to that. I understand that we are curtailing disbursement right now because of the microeconomic situations right now. But sir, when do we plan to accelerate on it?
Yes, you're right. We have been expanding our branches, especially in our emerging market verticals. And we have achieved whatever we wanted to achieve as far as distribution is concerned now. So last quarter was the last of the expansion. So we opened about 90 branches last quarter, and now we have reached 303 branches in total. Because of this expansion, overall distribution width and logins have improved. But as we had said in commentary, and you would also have been reading, overall from macro perspective, the current market is a little bit stressed in terms of customers being a little bit of over-leveraged. Hence, we have made our underwriting standards a little stricter. We anticipate that in next 2 quarters, things will start improving and the throughput accordingly will look to improve.
In addition to, sir, what Anuj has said, if you look at our track record from year 2022, from 3,000 crore, we have reached 12,000 crore, and then we acquired a business which added another 3,000 crore. One of the core, so we have demonstrated growth, that is not a problem, but we want to now reduce our input cost so that we can improve the profitability, which I think goes into the benefit of the shareholder. We believe that if you do a calibrated growth now, the total liability which we require to raise would come down considerably, and that's why that will reduce cost of liability, and hence this is strategy.
Thank you so much, ma'am.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Ms. Meghna Luthra from InCred Equities. Please go ahead, ma'am.
Yeah, hi. Thank you for giving me the opportunity to ask the question. I had a couple of questions. One, sir, can you please highlight or geographies, stress or over-leveraging on this stress part, on the ticket sizes or segments?
We lost you in between. Can you just repeat?
Hi, sir. Am I audible now?
Yes, you are.
Sir, I just wanted some more color on the ticket sizes or the geographies or the sectors in which are showing stress and which are not showing stress. Can you please provide some color on that?
So while there are no specific geographies or sectors which are showing higher stress, but in general, for micro and small SMEs, we have seen a little bit of higher over leverage. we used to do in emerging markets loans between 5 lakh to 50 lakhs ticket size. But for last 3 quarters, we stopped doing loans less than 7.5 lakh ticket size. So we saw a little bit of stress in segment which are adjacent to microfinance. And as a conservative measure, we stopped doing that. But other than that, across, while leverage is high, there is no particular segment which is showing higher than usual stress in our portfolio.
And sir, is there what kind of an impact are we seeing of the US tariffs? Any particular geography in Tamil Nadu or Gujarat? Is there any one-time or any hard impact?
So we are actually quite unaffected because since inception, as a policy, we have not been funding MSMEs which are export-oriented. So in our portfolio, the number of customers with some kind of export business is less than 5%. So there is hardly any impact on our portfolio.
Okay, sir. And just a few more things. One, on credit cost, what do you see credit cost pan out for second half of FY26?
So it would broadly, we think it will continue in the same trajectory. While this quarter has been relatively better from collections performance perspective, we hope that will continue, and both the GNPAs and the credit cost would be in similar range.
Okay, sir. And just lastly, on the AUM growth, sir, how do you see that pan out in the second half or in FY27?
So as Sachin mentioned in the opening remarks, we broadly add 3,000 crores of AUM every year, and because of Profectus acquisition, we have already done that. So we are using this opportunity to reduce our cost of borrowing by growing a little lesser on a standalone basis. So we foresee to grow by more than 3,500 crores at a consolidated level by this year end.
Okay. And for next year?
Very similar growth. So broadly, we would like to grow between 20 to 25%, and that's what we have been doing. So we'll continue that.
Okay, great.
But Megha,
yes, sir.
Sorry, just for your model perspective, I think the broad commentary is that we are now focusing more on productive growth, right? So headline number being one part of it. As I said in my opening remark, that out of our micro enterprises branches, what we call emerging market, we have 30 branches which are at 1 crore of monthly disbursement. We have 88 branches which are between 50 lakh to 1 crore, and we have 188 branches which is technically less than 50 lakh rupees. Now, given that the management attention to establishing new branches is completely over, in next first target is the next 12 months is that this block of 88 branches reaches to roughly around 72 lakh to 1 crore of disbursement, and the balance 188 branches reaches same 80 lakhs to 1 crore of disbursement in 18 months' time. Once we complete that, then these 333 branches would start delivering around 25 to 330 odd crore, and that portfolio will build at average blended yield of around 18.5%, and that would change both. That would increase the portfolio yield and the portfolio construct, and that is where the ROA deliveries would come from.
Got it. So that's very helpful. So these emerging branches would also have now they move to a slightly higher ticket size. That is fair to assume, right? Since we've cut down the less than 7.5 lakh ticket size.
Yes, a little higher because the between 5 to 7.5 portion has been cut out.
And currently, what proportion of the AUM on books is less than 7 lakhs?
Less than 7 lakhs?
Yes, sir. The ticket size the one that you mentioned that you've stopped.
It's hardly anything, I think less than 5%.
Less than 5%. Okay, great.
Yeah.
That's very helpful. Thank you, sir, for all the questions.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Mr. Mohit Oza from Elara Securities. Please go ahead.
Yeah, hello. Thank you for the opportunity. Am I audible?
Yes, you are.
Yeah. So, could you tell me what are the key tech initiatives undertaken by management that have been enabled better underwriting and risk management practices, and also your long-term ROE and ROA targets? Thank you.
So we have been actually great believers of data science since day one. So our year-on-year investment especially on our proprietary scoring model called Grow Score, is now what is yielding results. While we have the early warning system, which has got developed on basis that, is also showing us a little better anticipatory value, and that is why we have been able to take calls a little earlier than industry. Separately, through our MSL acquisition last year, which was primarily on basis of MSL's top-of-the-line tech platform for embedded finance, the portfolio has built in a very healthy way last year. So both these, the investment in Grow Score for last 7 years and the last year's acquisition of MSL is what has resulted in this kind of portfolio growth and portfolio performance.
Okay. And so long-term ROE and ROA targets?
So eventually, the ambition is to deliver a steady state ROA of about 4% and a ROE of 16 to 18%. Currently, we are at about between 2 to 2.5%, and that is what has been happened in last 1 year. So in next about 2 years, that is where we want to be.
Okay, sir. Thank you. That will be all. All the best.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone phone. The next question is from the line of Mr. Mohit Ansari from Hyderabad Investors Forum. Please go ahead, sir.
Yeah, I want to ask about further equity dilution. We have after this current round of equity dilution or raising the capital, till how much AUM this will be adequate, and when additional capital will be required? Is it around 18,000 crores AUM that we will need further capital? We need to just know about that future raising of the capital. And are we going to raise it at only 1x of the book value if the market price doesn't go up, market cap doesn't go up, or what do we intend to do about it?
Sir, as you might have seen that, our model necessitated that, almost at every point of time when we reach roughly around 18% of capital adequacy, we need to raise more capital. Given the kind of growth which we have been getting over last 4 years, every year and a half, around 18 months, we were raising capital. However, we, realized that, market acceptance or market pricing for Ugro has not caught up with the kind of growth and platform we have delivered. And that's why we raised both right issue money and preferential allotment of CCD in June this year. Incidentally, as soon as we acquired Profector, our tier 2 market opened up, and we were successfully able to raise roughly around 250 crore prior to September, and now around 350 odd crore. And once we did that, we saw that as an opportunity to protect dilution, and we requested some of the investors to put lesser amount of capital. And that's why we raised around 550 odd crore in preferential allotment and 380 odd crores in our right issue. So we reduced the capital raise so that we can protect dilution. Going forward, the way we are trying to build the model is to improve the profitability, improve return on asset, and reach our targeted return on equity so that the traded price improve and we comes in the range of what the peer set is. We think so that the company would not need capital on the current run rate basis for at least next 18 to 24 months. And we will calibrate between the choice between raising capital and calibrating the growth. We will calibrate growth first to ensure that we have sufficient return on asset, return on equity, and buffer of capital so that the traded price goes up. We can enable faster growth at any point of time. That is within us. Our platform is very large, but now we are calibrating it to make sure that our shareholders, benefit from this growth rather than getting diluted at every point of time.
Present capital structure, how much AUM can it support? Around about 18,000 crores or how much AUM can we raise by the present capital structure?
Sir, it depends. It depends in which product line we grow. The current model of growing the micro enterprises business, which is far more profitable, we think so we can stretch ourselves up to 20,000 odd crore, 18 to 20,000 odd crores.
Okay, so our AUM target for next 2 years is going to be around about 18 to 20,000 crores. That's all. This year it will be 16,500 crores, and next year, FY27, it will be around about 18 to 19,000 crores.
You are right.
That's the maximum that we can go up without raising any additional capital.
You are absolutely right, but if the model and its quarter-on-quarter improvement in our metrics delivers a higher base of equity value, then we would look at differently and enable further growth. But on current capital basis, your assumptions are right.
And what about the book value, sir? How much is the present book value, and what will be the book value at the end of March this year?
Our present value.
After Profectus acquisition, what will be the combined book value of the Ugro?
Right now, our book value is 190 rupees.
After Profectus, how much will it be?
Yeah, it would be around same, sir.
It will be 190 rupees. Okay. So our competitors are trading at 4x of the book value. That's what you should say.
So that, depending upon who you treat our competitor, I'm very happy that those who trade at 4 times book value as our competitor is a matter of compliment. We hope that we also get there very soon.
Hopefully. Okay. Thank you.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Mr. Ayush from PricewaterhouseCoopers, PwC. Please go ahead.
Hi. In past 1.5 years, CCDs have been issued and capital has been raised from that, and those are coming to an end and conversion would happen to the shares. Some people would book profit there as well. So how do you think it's going to affect the P of the company, equity dilution, and financials of the firm? If you can throw some light on that.
Sorry, I'm not clear with your question. So you're saying that on a fully diluted basis, what would be the the P of the company? Is that what you're saying?
Yeah, the selling of the CCDs will be converted to shares and selling of them, that will happen. So how do you expect P is going to be affected? Equity dilution is going to be affected. What is your view on the future on that?
No, I'm not very clear. So today our outstanding number of shares is 12 odd crores. When all of this equity would convert, which should happen in the month of December, the total fully diluted number of shares would be around 15 crore. 15 crore 85 lakh shares. So on a 15 crore 85 lakh shares, so I think what EPS is currently would be remain the same. So if there are those who convert the shares, if they sell in the market, that doesn't change the EPS of the company. That will go in the market.
Okay.
Thank you. Participants, if you wish to ask a question, please press star and 1 on your touchtone telephone. We will wait for a moment while the question queue assembles. I repeat, participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Mr. Rishi from Lavish Ventures. Please go ahead.
Yes, hi. Am I audible?
Yes, sir.
Yes, you are.
Yes, hi, Mr. Nath. Thank you very much for answering all the questions. I have a question regarding what exactly happened in the recent notes conversion. So the communication staff said that Samina reduced their actual conversion based on the company.
Sorry, your voice. Sorry, we can't hear you at all.
Oh.
Sorry,
I'm very sorry. Just give me 1 second. Ms. Nath, can you hear me now?
Yes.
Yeah. So based on the communication to the exchange, we know that Samina had reduced their allocation based on the company's request. So the question is, so they are left with outstanding warrants at this point in time. And Origins and others have been compensated for the 12% that they had paid upfront for the warrants as well. Could you just let us know how much of the warrants is now still remaining and not extinguished? And, well, I mean, of course, it depends on the market price to see if that any of which will convert later. So just a query on how much warrant is still pending.
So all of the warrants are still pending. Roughly around 465 crore worth of warrants, divided by 265 rupees, would expire on December 5th, and around 550 crore worth of warrant would expire on December 17th.
Okay. And those who do not exercise it will be paid 12% of the warrant price back. And those who exercise will not be paid the 12%. Is that understanding correct?
No, sir. The CCD allotment which we did last time had 2 coupons. One 12.5% was upfront, and 12.5% was linked to the exercise of the warrant. But finally, exchanges asked us to remove the linkages from the warrant. So the entire coupon on the CCD has already been paid. So there is nothing to be paid further on the warrant. So the warrants are free warrants, and there is nothing to be paid now on exercise or non-exercise of the warrants.
So the second 12.5% was not paid. So the CCDs were converted at 185 minus 12.5%.
No, sir, it was disclosed to the exchange. Both the coupons have been paid at post-issuance of the
both have been paid.
Yes.
Okay, understood. And if the warrants are not exercised, will that be a profit recognized in the next quarter of around 200 crores?
No, sir. That would get into forfeiture, and finally this get adjusted to the coupon which we are paying on the warrants, on the CCDs.
Thank you, Mr.
Both are being capital account transactions. There is a forfeiture on one side, and there is a payment on CCD other side.
Okay, understood. And there would still be a remaining profit to the company because it's less than 67, the forfeiture. The forfeiture is 67, whereas the payment was around 35.
Absolutely. So you're right.
Okay.
So now the accounting treatment of that may not reflect an exceptional gain because in the index the accounting is done little differently. But purely on math perspective, the warrants were 1,000 crore versus the CCD issuers were roughly around 500 odd crore. So definitely, yes, there will be some difference.
Okay. Thank you, sir.
All those are capital receipt nature.
Okay.
Thank you. Participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. We will wait for a moment. As there are no further questions, I would now like to hand the conference over to the management for closing comments. Please go ahead, sir.
Thank you, everyone, for patiently listening to us. If you have any further question, you may get in touch with Ritu or to any of us directly. We would be happy to, answer and clarify. Thank you for your time.
Thank you, sir. On behalf of Ugro Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.